Welcome to this Killick Explains video and welcome to part 2 in my 4-part series on equity analysis. This time I'm going to take on one of the ratios I mentioned in video 1, and that is the price to earnings ratio or PE ratio. For some people the king of ratios, not for everybody. So what is it? Now in part 1 we looked at not overpaying as part of a key plank of equity analysis, and we said as part of that we want value for money. Multiples, such as the PE ratio, are going to help us to establish whether we've achieved that or not. And basically, with all these multiples, in principle, the lower the multiple, the better value the stock you're looking at, with a few caveats I'll come back to in a moment. So some price-earning ratio basics. What is this thing? Well, first of all, it is a measure of value. It's a way of looking at a stock, getting a snapshot, a single number, a single metric, that tells you is the stock cheap or expensive. It's mechanically the current price versus 1 year of earnings. And those earnings can be either forward. Now most equity analysis is done looking forward, looking ahead, looking at the next investment decision if you like, or you can take the recent known latest 1 year historic earnings figure. So there are a couple of ways it can be calculated, and when we're looking at the forward number, it's sometimes done on a consensus basis, as it's called, straw polling, Bloomberg analysts and so on. But what's it basically telling us? So let's say you've got the price, £1, and you've worked out that the forward earnings estimate is 10p. So you've got a P ratio of 100 over 10 or 10 times. What does that tell you? Well, in essence, it tells you how long would you have to wait on a undiscounted basis. That's assuming that earnings don't change and we're not looking at too much inflation. You might say slightly unrealistically at the moment, but basically it's how long will it take to get my money back. So a P ratio of 10 very crudely suggests it might take a decade to get your money back, let alone make any money. So how do we interpret this P ratio of 10 for argument's sake? Well, we need to benchmark it. We need to look at what it was in the past. We need to look at management estimates, if you like. We need to look at analyst estimates. We need to look at other businesses. We need to look at the wider market. There are lots of things to benchmark it against, but fundamentally low is cheap and high is expensive, very crudely speaking. So a PE ratio below the average, below the benchmark is potentially good value, and one that's way above it is potentially expensive. Now, what are the traps? Well, there are a few traps, basically. First of all, it's only one number. So the PE ratio in isolation doesn't tell you an awful lot by itself. Secondly, earnings is quite a subjective number. There are lots of accounting adjustments made to even get to a historic earnings figure, let alone a projection out into the future as to what earnings might be. So you are leaning heavily on those earnings estimates if you're going to draw conclusions from a forward PE ratio. And thirdly, accounting issues abound. I mentioned or hinted at them just now. An earnings number is the figure you get to when you take sales and deduct quite a few subjective items to get to earnings or profit, depreciation, amortization and so on. And some analysts don't like earnings for that very reason. But nonetheless, whatever your view of some of those accounting quirks, the PE ratio remains an important valuation tool and one that's published fairly widely. Now, that was pretty brief, and if you're thinking I'd quite like to know more, well, killick.com/learn is our comprehensive video library, and there's a shares tab and a ratios tab somewhere down there. Then there's my guide, How to Invest in Equities. It's one of 6, that's why they're all different colours next to me. That one's editor at killick.com. And then if you'd like a copy of Confidant, the magazine sitting next to me, the quarterly magazine where some of our equity research team use this stuff live, if you like, then that would be editor at killick.com too.